Well, hi, everybody, and welcome to the Buffett and Beyond Stock Analysis Video Podcast with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi, Debbie.
Just me. Hello.
And all these methodologies are based on the book Buffett and Beyond, second edition by Dr. Joseph Belmonte and published by Wiley Publishing. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. Now remember, folks, the clean surplus return on equity is both a comparable and a predictability model and is totally different than the traditional accounting return on equity. So don't get them mixed up. And you can equate the clean surplus return on equity as the interest rate you get from a bank. So this is common sense now. A bank account with a higher return or interest rate will earn you more money than an account earning a lower interest rate. So it just follows that portfolios made up of stocks with high clean surplus ROEs or return on equity will outperform other portfolios made up of stocks with lower return on equity or interest rate. So think of your bank account when we talk about these stocks. The good.
Stocks that should be in our portfolio.
The bad.
Stocks that should be in somebody else's portfolio.
And the ugly.
Oh, stocks that should be in nobody's portfolio.
Okay, let's get on with some stocks. You'll see exactly how this method works and how we here at Buffett and Beyond set the investing parameters so that you, all of you, can outperform most of the professional money managers out there in investment land. And today we're going over the service industry, and folks, these are three good stocks, believe me, yeah. And the first one is Booz Allen, which I bet you never heard of. And the second one is Rollins Incorporated, which is the owner of Orkin. Think bugs, folks. And the third one, Healthcare Services. So let's get right into the first stock. Okay, Debbie, what do we have?
All righty. Well, you said it. We have first up, we have Booz Allen Hamilton Corporation. They provide management and technology consulting services to the U.S. government, both defense and civil, major corporations, institutions, and not-for-profit organizations. 97% of revenues are derived from contracts where the end client was an agency or department of the U.S. government, with the Navy and Marine Corps accounting for 13% of the top line. They have contacts with the U.S. Army and Navy for more than 65 years. And as of 3/31/18, the total backlog was $16 billion. They have about 24,600 employees.
Yeah, and it's a company that's been doing business for 65 years with the government, and we've never heard of it. And let's look at the numbers, and the first thing we want to look at is the clean surplus ROE on Booz Allen. And remember that to get into our growth portfolio, we'd like to see an ROE of 20%. I'm talking about the clean surplus ROE. And think of the clean surplus ROE as a bank account that's earning a certain amount of money or a percentage. And we'd like to see a clean surplus ROE of 20% or greater. However, if a company's ROE is rising, that gives us pause because the market loves a rising ROE. And what does that mean? It means that the earnings are increasing, but each year they're increasing at an increasing rate. So rather than, say, going up at 16 or 17% a year, if that ROE goes up, that means the earnings are increasing not at a steady rate, but at an increasing rate. So that's why this stock has done pretty well over the past couple of years. And you can see that down in 2016 and 2014, the ROE was around 13-14%. And projected for 2019, it's going to be just about 17%. Now, the thing that bothers us is the retention rate here. The retention rate is how much of the money the company is making does it put back into the company in order to grow. And it's about 70% averaging over the past several years or so. And the net income growth is a little lower than our universal stocks, and the revenue growth is a little higher than our universal stocks. The thing that does bother us also here is the years to pay debt. And remember what Buffett says about this is that if a company takes all the money it's making, how many years will it take to pay off its debt? And in this case, it's 4.2. Buffett's rule of thumb is 5. We like to see it at around 3 or so. So this company has a little bit more more debt than we like to see, but of course, with all the government contracts, you can be pretty sure they're going to get paid. So, not a high enough ROE, even though it is rising, and the net income and revenue growth are about average when you take the two of them together. And as we see over the past 12 months, so this is the past 1 year, it is up 40% while the market's up about 4%. So folks, it has been having a banner year, no doubt about it. And Debbie, what's our next stock?
And that would be the Rollins Incorporated, which, as said, they own and operate Orkin, LLC, Exterminating, one of the world's largest pest and termite control service providers. Has over 500 locations, including franchises in the U.S., Canada, Europe, Latin America, the Caribbean, the Middle East, and Asia. Commercial and residential pest control account for 82% of revenues, and the balance is mainly from the termite business. Ooh, those little buggers.
Yeah.
They acquired Home Team Pest Defense in '08, Crane Pest Control in '08, and 2 acquisitions in Australia in 2014.
Yeah, they have bugs down there too, folks.
They've got them everywhere. And they have about 13,120 employees.
Going to the numbers on Rollins, we see that the clean surplus ROE is way above our threshold of 20% and rising over 2018 and projected for 2019. So we like to see that. Thing that's bothering us is the same thing as Booz Allen, is that the retention rate is around 50%, which means it's taking the money that it makes, putting half back into the company in order to grow, and half it pays out in the form of a 1.1% dividend. What we like about Rollins is, number one, it's in the bug business, and there's always bugs, especially if we have global warming, folks. I'm being a little silly here, but we have global warming. There's going to be more bugs, so this company just may be growing. And years to pay debt, it has no debt, and that's what we like about this company. Now, the net income growth is a little above average, which we love, and net income is your profit. And revenue growth is a little below than average, so that has us a little bit worried, but revenue growth over the years is averaging about 6.5%, so that it's right there at average, and most companies are growing only about 4% for 2019. So it's a little above average with the revenue growth when we consider the 2019 projections. Net income growth is above average, and it's been doing very, very good. As we can see over the past 1 year, it's up about 18% with the market up, well, it looks like about 3.5–4% in here. So it's done well, not as good as Booz Allen over the past 1 year, but we're going to take a look at them all together in a few minutes. All right, Debbie, what's our next stock?
And finally on this podcast is Healthcare Services Group Incorporated. They provide housekeeping, laundry, linen, facility maintenance, and food services to the healthcare industry, primarily in the United States. Its housekeeping services consist primarily of cleaning, disinfecting, and sanitizing patient rooms and common areas of a client's facility, as well as the laundering and processing of the personal clothing belonging to the facility's patients. They have about 55,000 employees, 88% hourly, and 10% unionized.
And as we're looking at healthcare services, which is, of course, in the healthcare business, we see that this ROE is exceptionally high, and it is expected to be really high for 2019. The thing that bothers me is that the price is not reacting to this 42.6% projected ROE for 2019. And when we look at the retention rate, we see that the retention rate is below 50%, which means it's paying most of what it makes out in the form of a 2-point-something% dividend, and it's putting about, on average, about a third of what it makes back into the company in order to grow. And this company has had restructuring of its contracts in its services, and that's why it hasn't done well this past year, which we're about to see in a second. Now, net income growth for next year is expected to be, or for 2019, this year, is expected to be about 54%, which is just knocking it out of the park. As I mentioned, the stock is not reacting to that number, which gives me pause about this projection number. And revenue growth is right around average at 7.1%. Years to pay debt, it has no debt. So let's look at how it's performed over the past 1 year. And because of the restructuring of those contracts, the market just doesn't like what it sees because it may be on a downward path as to earnings increases. And let's look at the past 5 years in this stock, and you can see that it was doing very, very well right up until 2018. And you can see it took a big hit, and it has been traveling along with the market, or in other words, averaging what the market's been returning. But folks, we want stocks in our portfolio that's outperforming the market, not that is performing as well as the market. Otherwise, we could buy the market. So let's look at these stocks together, and Booz Allen is first with about a 17% ROE, Rollins with a almost 26% ROE, Healthcare Services just blowing it out of the water at a 42% ROE, which is a little bit suspect. So when we look at these stocks, we say, which one should we be replacing in our portfolio? Because remember, we're selling Ultimate Software, or we actually sold it in our portfolios, and we had to replace it with something. So we're looking at the service industries here, and we have to decide out of these three stocks which ones we're going to put into our portfolio to replace Ultimate Software. And looking at the 1 year, here we are, all three stocks together. The black line is the S&P 500. Booz Allen is leading the pack with a 40% return. This is for the past 1 year. And Rollins with a 20% return, the market with about a 3 or 4% return, and Healthcare Services with a negative 18% return. But let's take a longer look so we get rid of this past 1 year that Healthcare Services has had, and we can see that over 5 years, Rollins leads the group with about a 210% return, while the market is returning 50%. So Rollins is exceeding the market by about 400% over the past 5 years, followed fairly close by Booz Allen, and it was 2018 that Booz Allen had a very, very good year, but can it keep it up? And remember, when we looked at the growth in net income for Booz Allen, it wasn't going to be as high for 2019. So we have to see whether Booz Allen could keep it up. And of course, Healthcare Services is now performing as well as the market, and until it gets those contracts in its pocket and signs on more customers, we think we'll stay away from Healthcare Services. So Rollins, which is in the termite business, in the bug business, and folks, they're going to be around forever. So we are going to go with Rollins, and it's the stock that has performed the best over 5 years, and it's in a service business that people don't skimp on bugs when a recession comes along. So it's a pretty good company, folks. And that's the one that we're picking out of these other two stocks, folks. Even though the other two are pretty good companies, and once Healthcare Services gets going again, I think it'll be a stock that might be worthy for our portfolio maybe next year, but we'll see how it does. So meanwhile, Rollins is our pick going forward, folks.
Well, JB, I think we've just about covered all the questions sent in by our listeners out there in investment land. And remember, folks, we're here to answer your questions not only about individual stocks, but also about the stock market in general. So keep those questions coming, and who knows, we may even answer a question or two you didn't even know you had. And that's about it for today, JB.
Okay, folks, don't forget, if you want to receive a full free month of all our letters and complete access to our computer program, just go to our site, BuffettandBeyond.com, and sign up. Remember, all you need to manage your own portfolio, and it's free. Hey, just go to BuffettandBeyond.com, and remember, Buffett is spelled with 2 F's and 2 T's. That's BuffettandBeyond.com. Okay, folks, we had a great day today.
And tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. We've had a good week, folks, and here's hoping that next week will be even better. You have a safe weekend, and we will see you next time.